Yeah, what do you want? GAAP. Alright, give me 1 minute, I'll explain to you.
Close the door.
Alright guys, our word of the day is GAAP. GAAP stands for Generally Accepted Accounting Principles. These are the standard and accepted ways of recording and reporting in accounts. GAAP is an extra acronym of Generally Accepted Accounting Principles. That means basic principles and guidelines such as cost concept, matching concept, full disclosure concept, etc. GAAP must be followed when company distributes the financial statements outside the public. If corporation stock is publicly traded, the financial statement must be adhered to GAAP, which again got the financial statements audited by the independent accounting firm. GAAP is generally used for auditing purposes. GAAP comprises of a broad set of principles that has been developed by accounting profession. That's it.
Hi. Alright, now let us see why GAAP is important. GAAP is exceedingly useful because it attempts to standardize and regulate accounting definitions, assumptions, and methods. Because of generally accepted accounting principle, we are able to assume that there is a consistency from year to year in the methods used to prepare a company's financial statement. And although variations may exist, we can make reasonably confident conclusions when comparing one company to another or comparing financial statistics to the statistics for its industry. Now let us look on various principles of GAAP. Let's talk about cost principle. From an accounting point of view, the term cost refers to the amount spent when an item was originally obtained, whether that purchase happened last year or 30 years ago. For the reason, the amounts shown on a financial statements are referred to as historical cost amounts. Because of this accounting principle, asset amounts are not adjusted upward for inflation. In fact, as a general rule, asset amounts are not adjusted to reflect any type of increase in value. Hence, when an asset amount does not reflect the amount of money a company would receive if it were to sell the asset at today's market value. Next is economic entity assumption. According to the business entity itself, in episode to capture the transaction of the business is different from that of the owner. For example, needless to Marcel, the store company manager at CCD Lavasta, the personal transactions are completely different from that of this company.
Now the second concept is the realization concept. You need to understand in this the profit is only recognized when it is realized. What basically I'd like to say with regard to that is, sale is only deemed to have taken place when the ownership of the goods have been transferred to the person who is receiving it actually. Got that? Now I can start my example. One example that I can cite to you in realization concept is, for example, Richard, who is presently taking the video. If he is a seller of a couple of shirts and if I place an order with him, is that the point of sale in that scenario? If I pay him a total of 1000 rupees instead of 2000, which is the total sum, does that make it the point of sale in the scenario? If Richard actually starts working on those shirts, does that mean that the sale has started? Or when Richard gives me the shirts, does that become the point of sale? So the answer to this question remains the last one. When Richard provides me the goods or services, is the actual point of sale in this matter?
Okay guys, let's talk about the materiality principle. The materiality principle states that an accounting standard can be ignored if the net impact of doing so has such a small impact on the financial statements that a reader of the financial statements would not be misled. Under GAAP, you do not have to implement the provisions of an accounting standard if an item is immaterial. The definition does not provide definitive guidance in distinguishing material information from immaterial information. So it is necessary to exercise judgment in deciding if a transaction is material or not. For example guys, this guitar could be material for some companies if they value it in their books of accounts as an asset, and the same could be immaterial for some other company which considers it as a sundry expense. So guys, that's all about materiality in GAAP.
So now, let's have a look at the full disclosure principle. The full disclosure principle states that you should include in an entity's financial statements all information that would affect a reader's understanding of these statements. The interpretation of the principle is highly judgmental since the amount of information that can be provided is potentially massive. To reduce the amount of disclosure, it is customary to only discuss information about events that are likely to have a material impact on the entity's financial position or financial results. This disclosure may include items that cannot yet be precisely quantified, such as the presence of a dispute with a government entity over a tax position or the outcome of an existing lawsuit. Full disclosure also means that you should always report existing accounting policies as well as any change to these policies, such as changing asset valuation method from the policy stated in the finances for a prior period. So, let's take an example.